Tower said recently it was going to be looking for non-private equity partners in its deals. It was going to be taking more mezzanine deals and would even consider doing minority investments. Have you guys thought differently about the strategy of the way you do deals, the types of deals that you look for based on the downturn?
I'll take that just to start. It's funny because in the last few years, we're counter-cyclical. We've been trying to figure out ways to do things in the prior 5 years. We did some minority deals, we did some deals with partners. Now we're going back to let's do a carve-out where we own 100% of it. Right? So we're kind of coming back to our core. So it's the opposite. It's not really how do we find something new. Although we just did a deal with Siemens where we bought a division partner with them, they kept 49%. Those are the kinds of deals where you're sharing upside with a seller. In this market, help bridge this issue Phil mentioned, right? Because sellers have, geez, we wish we had sold. Well, here's a way to bridge it. Let them play in the ups with you. I think there's going to be more of those. We'll do more for sure.
Well said. I think there'll be a lot more minority deals. Our firm grew up as a minority investor. First 2 funds were exclusively minority, and now about half of our deals, we've done 300 deals, about half of them are minority. I think you'll see a lot more minority deals. We also have a mezzanine fund that's a $850 million sub-debt fund that allows us to do the financing, so we don't need to go and rely completely on senior financing for some of these deals.
Good. We similarly do about half our deals historically have been minority investor deals for us. And I'd say we're seeing a lot more seller paper right now as well, in addition to either earnouts or rolling 20% stakes. So that there's a lot of creative ways if a seller is worried that somehow we're getting the better end of the bargain. If you really believe in your projections, we're more than happy to figure out a way to structure some more upside based on the business that you're presenting it can be. And if we get there, we're more than happy to share that upside at the back end with you.
One of the first things I learned when I started studying finance was running out of cash sucks. It's about the only thing I needed to learn. After that, I understood every industry a lot better, in the private equity industry especially. So when stocks fall, large pension funds, retirement plans, and other limited partners are often forced to rebalance their portfolio. They have a certain allocation target. They're going to say we're going to do 20%, 50%, whatever it is. A certain percentage of our money is going to go into private equity and buyout deals. What's this going to do for the next round of fund commitments? Stocks have fallen. We got to see smaller allocations to the buyout market. Some people are not going to even be able to raise their next fund. Other people, first-time funds, probably toast. What is the market looking like for you guys?
I think you said it well. I mean, I think that it's always been true in our industry that the vast majority of the returns are for the top quartile funds, if you actually just look at it. So it's important to be a top quartile fund, and then now in this market, it's even more important to be a top quartile fund. You're also seeing that in the hedge fund industry, which now I saw a stat that the top 100 hedge funds have 75% of the capital, which is way up. So what you're seeing is a rush towards quality and the shakeout, in the industry.
The only thing I think it's sort of historically the big investors in our funds have either been public pension funds or it's been the college endowments. And I'd say there's some massive college endowments out there that can weather a storm for a very long time without needing cash. I think some of those guys are actually going long now and seeing the opportunity of, geez, why wouldn't I go? This could be great vintage for private equity, whereas it's too bad I invested in a lot of those 6 funds that may not look as good. I think it's a different story right now on the pension fund side. You read about CalPERS right now, which is cash constrained. If you think we're the most illiquid asset class out there. I mean, a hedge fund isn't exactly liquid, but at least you hypothetically have the ability to put in a withdrawal notice and take your money out in 90 or 120 days. And with us, it's truly locked up for basically 10 years. I think there's going to be a lot of, particularly the pension fund side, groups that just can't play in private equity for the next couple of years. They just, in a market that creates liquidity, we're not the answer to that.
Scott?
Oh, I agree with all that. I think just maybe something to add. There's always money out there. Right now, Abu Dhabi's sitting on $1.3 trillion, last I heard, cash. Right, so there's cash out there. It's a matter of freeing it up, from those that have it. And right now, what's interesting is even the smartest money on the LP side is sitting on the sidelines. We just had our annual LP meeting last week, and we heard from a number of LPs, look, we are done for the year. It doesn't matter. It could be the greatest opportunity we've ever seen. We're not even looking. So, but that will change.
So we've seen some big firms that have had problems fundraising already. Madison Dearborn missed its $10 billion target earlier this year. Carlyle pushed back the projected $15 billion close for about 6 months and may miss it as well. Blackstone did $21.7 billion last year for its fund. Now it's pushed back the first close of its latest fund to earlier this year. Look, how bad is it going to get? Is this going to be the news that we're going to be telling for a long time?
It's going to be really, really tough to raise money.
Good enough. Anybody here expecting to raise money in the next 12 months? Oftentimes, investors are required by the SEC to not say anything about that, as that would be a solicitation of funds. We're all friends, you can tell us, really.
No, but you guys want to write some checks, we'll talk about it.
Right?
You heard sovereign wealth funds mentioned earlier. There's big pools of money controlled by foreign governments, and they put a lot of money into the investment banks just prior to the credit crunch and got burned pretty badly. We've seen their presence as a limited partner in buyout fund, of course, increase over time. Are they going to be a reliable source, really, Greg? Is that going to happen?
That's not a source of capital for us. We've been with public and private pension funds and major universities and endowments. I can't answer that question. I don't really know. Yeah.
Well, same thing, they're not with us, but I would say in general, yeah, they're going to have capital and they're going to have more of it. And most of the sovereign wealth funds are oil, right? Big ones. Or some version of a natural resource, and there's more money coming into them and they're going to have to put it somewhere. So I'd say yes.
Good, good. A question about the future. Are we going to see carried interest? That's the profits that you guys make on the investments that you do. Are we going to see that taxed in the next administration? Is that going to be taxed? It traditionally has been taxed at the capital gains rate, and the question has been, will it go up to the personal income? So is that personal income that you guys going to be taxed as personal income?
Who knows, right?
We see where you-
Anybody want to take a guess on that?
I think, we obviously are in touch with all this, and there's a lot of communications with the government. I don't know for sure, but if I had to bet, I'd say yes.
See, I might take a little different view, which is to make the answer yes, you have to unfairly single out a single type of investor versus, the entire universe of what's treated as capital gains. I'm not sure that will actually happen when people really get through it all. I think there's a lot of sentiment to push on it.
As long as there are no $5 million birthdays anytime soon.
Do you want to treat every, some entrepreneur starts a business, should that be capital gains or ordinary income, right? You got to change, to be fair, and once you get through the whole thing, if you really want to change it, you got to change it for everyone. Someone might take a, pot shot just at this industry and try to make it happen, but not sure it ultimately passes these.
So when it's a bailout, decisive action is good, but when it comes to increasing taxes, decisive action is bad. I just want to be sure I heard you